Welcome to another Southbank Investment Bulletin. So I thought we'd kick off this week by sharing a chart that I created, golly, it must be 14 years ago now. What I wanted to do back in 2012 was monitor how central banks were creating new money. And it was quite obvious back then that the volume of cash that was being created by central banks was affecting markets, and that it was one of the primary tailwinds for asset price appreciation. And that has been pretty true all the way since then. That's one of the reasons why I kind of think of this bull market that we've had on Wall Street in particular as being liquidity fueled. Now, then if we're going to monitor liquidity, it's important to realize that uh, the size of central bank balance sheets peaked in early 2022 at 33 trillion. And now it's below 28 trillion. So we've seen at least 5 trillion taken off the size of central bank balance sheets. But that isn't really even halfway through unwinding the massive increase in the size of central bank balance sheets between 2020 and early 22. So that was a $13 trillion increase in the size of central bank balance sheets. And that's from not just the USA, but all of Europe and China and Japan as well. So we're talking about a phenomenally large amount of money that was printed. And then is it little wonder that we've had such an increase in both inflation as well as the price of everything, including stocks and bonds, and then also other kinds of assets like watches. And then is it altogether surprising that in the last 2 years, we've seen that some of those asset prices have started coming down. So we saw, for example, Rolex watch prices coming down, used car prices coming down, bond prices coming down. We had a significant correction in the crypto sector. Then the stock market corrected in 2022, but rebounded in 2023. So it's not only that we have this I guess, change in the trend overall of central bank balance sheets. There is only very limited ways that we have to monitor just how much money are governments spending. So I saw this chart last week, and I thought it was particularly interesting. And what it helps to highlight is that there was, heading into the election of President Trump, that there was a very strong correlation between unemployment and the deficit in the USA as a percentage of GDP. You can see that every time unemployment went up, the deficit went up, and that makes sense. When you're going to have the deficit rising is when a lot of taxes are going down because the government first has to stimulate to try and encourage people to hire more workers, but they're doing so at a time when there are people that are more unemployed, so they're not paying taxes. So then the deficit goes up at the same rate that, or goes up at the same time that unemployment goes up, and then it should also come down. We saw that on multiple occasions from 1970 through until about 2016. Then you had the Trump tax cuts, and that was a pro-cyclical event. So what happened was the US government started printing more money, spending more money, cutting taxes at exactly the same time that unemployment was actually falling. There wasn't any need for it, but they did it anyway. And what that has contributed to is a massive deficit. Now, what we have is exactly the same situation in the aftermath of the pandemic. So what that also helped to highlight is that the deficit will increase during periods of high unemployment, but then it did not come down during periods of low unemployment. So when we think about the rebound we've had in markets over the last year, it's really been about deficit spending rather than central bank liquidity provision. And I think that's important because when we think about the performance of something like the Footsie 250, it has rebounded quite emphatically from the region of that 200-day moving average. We can see very clearly that there was a very clear sequence of lower rally highs and a little bit of a change in early 2023, but then back to the sequence of lower rally highs. It got down to test the low and rebounded, and now it has broken that sequence and is finding support in the region of the 200-day moving average rather than resistance. That's really quite positive. Now, what it suggests is that the UK market is recovering. And it's not only that the UK market in the mid caps is recovering, but the Footsie 100 is also steadying. Now, I think I really wanted to illustrate that over the course of the last 24 years, if you'd only invested in the Footsie 100, you haven't really done very well. And it's been quite a while since UK investors retreated to a real bull market. Now, the big move higher from the early 1980s through to the peak in 1999, that was a real bull market. That was an event where the Footsie 100 went from 1,000 to around 7,000 in the space of about 20 years. And even during the big pullback in 1987, it was completely countermanded within about 18 months. So that was a really big bull market, and then it ended, and it gave way to this exceptionally lengthy period of P ratio contraction, rising dividend yields. That's basically the definition of a secular bear market, and now there's the possibility that it's ending. So one thing that we know about stock markets is that they are discounting mechanisms, which basically implies that they take future cash flows and they give them a present value. In other words, they're taking all of the bad news that people are aware of today and they've already priced it in. As the stock market starts to do better, what it is pricing in is the potential that the UK will come out of this funk and will be in a better position in future. Now, I know that's hard to square away when you have such negative sentiment right now, and you have politicians that are running around like headless chickens and don't seem to know what they're doing. But one thing we certainly know is that the UK government finances are tight, but that the duration on the debt is long, which means that they don't have urgent funding demands. And there are certainly measures that can be put in place to improve efficiency, and they don't require a rethinking. They don't require a reinvention of the wheel, but deregulation in an economy like the UK could have a profound effect on productivity. So when we look at the performance of the stock market, it is quite likely that it is performing better because investors are pricing in the potential that the UK will do better in future, even though it doesn't look particularly enticing in the very short term, just from an ordinary citizen's perspective rather than an investor's perspective. Then let's also pay attention to how the pound is trading, because it has been incredibly inert for the last 2 months, and it is right in the region of the 1,000-day moving average. And most particularly, it has bounced from the 120 area, and 120 had been an area of support on several occasions over the last 6 or 7 years. And now it has bounced from there again. Now, if it can push up through this level, well, then that's going to enhance the potential that it will come back up towards the 140 area. So that is also something that I think investors will be paying attention to. It's certainly something that foreign investors will be paying attention to. If UK growth can recover from where it is right now, and I do think that there's a clear risk in the short term that we're going to have a recession. But then the stock market doing this well in an environment where a recession looks imminent suggests that a lot of bad news is already in the price. So we may be looking at the potential that a recession will be mild and that subsequently growth can reaccelerate. It is certainly not something that is the base case for most people, but the stock market is suggesting that that is a potentially likely scenario. And I think with that, I'll leave you for this week and wish all the best to all of you.